It's a common scenario. You drafted a business plan, projected revenue, and setting it aside. When reality hit, it failed. Cash ran out by February, marketing drew the wrong clients, and pricing barely covered costs. The failure wasn't the template, it was making fundamental errors by planning without understanding your operations. This is episode 4 of our 5-part series on building a photography business plan. In episode 1, we covered the complete overview. In episode 2, we went deep on templates. In episode 3, we explained what a business plan actually is and why it matters. Today, we're identifying the 3 most damaging mistakes in photography business plans and showing you how to fix them before they become business-ending problems. I've watched talented photographers in Los Angeles build beautiful portfolios and then close their doors within 18 months. Not because they lacked skill, because their business plans contained the same predictable blind spots. The good news is that these mistakes are preventable once you know what to look for. Cash flow problems kill more photography businesses than bad marketing or weak portfolios. The pattern is consistent. A photographer builds a plan that looks profitable on paper, launches with confidence, and then discovers that actual expenses exceed projections by 30% or more. By the time they recognize the gap, their reserves are depleted and their options are limited. The disconnect between projected and actual costs stems from a fundamental planning error. Most photographers budget for the expenses they can see, like gear, software, while ignoring the expenses that only become visible after they start operating. This creates a financial plan that works in theory but fails in practice. Self-employment tax at 15.3% of net income is the most commonly forgotten expense in photography business plans. You budget for gear and software, but you do not allocate 25 to 30% of every payment for taxes. April arrives and you may owe thousands you do not have. The expenses that disappear from most projections include self-employment tax, due quarterly, but often ignored until year end. Equipment replacement funds, because professional camera bodies require replacement every 3 to 5 years. Health insurance if you leave employment, slow season reserves because bills continue when bookings do not, and software subscriptions because $150 to $250 monthly seems minor until 12 months compound them into $1,800 to $3,000 annual expenses. The photographers who survive their first 2 years are not necessarily more talented. They are usually more realistic about what their business actually costs to operate. Build your expense projections from actual invoices and receipts, not estimates and assumptions. Profit and cash flow are fundamentally different. You can show a profit on your annual statement while being unable to pay rent in March. This happens because revenue arrives on its own schedule while expenses arrive on theirs. Commercial clients pay on net 30 or net 60 terms. You deliver work in March, invoice immediately, and receive payment in May. Meanwhile, April expenses for software, insurance, and marketing still require payment. Wedding photographers collect deposits during booking season, then carry 8 straight months of expenses before peak season revenue ever comes in. 82% of businesses' failures stem from cash flow problems, not lack of profit. Your business plan might show annual profitability, but monthly insolvency kills businesses before annual profit matters. If this sounds uncomfortably familiar, that's exactly why the Elite Success Accelerator exists, to fix the branding and positioning gaps that quietly break pricing, cash flow, and long-term stability. Start joining for free, link is in the description. Map your expected payment dates against your fixed expense dates. If you see months where outflows exceed inflows, you have identified a cash flow gap that needs a reserve or alternative income source. A vague target market does not just make marketing harder, it makes every marketing decision worse. When you do not know exactly who you serve, you cannot determine where to advertise, what language to use, or what price signals quality versus overpricing. You end up spreading effort across channels that do not reach your actual buyers. Marketing to a broad audience results in 50% lower conversion rates than marketing to a defined niche. That statistic should alarm you. Half your marketing effectiveness disappears when you fail to specify who you are trying to reach. Marketing to couples getting married tells you nothing actionable about where to advertise, what language resonates, or what pricing point to target. Marketing to couples aged 28 to 35 with $50,000 plus wedding budgets in Los Angeles tells you to advertise on wedding planning platforms frequented by high-budget couples, use language emphasizing luxury and personalization, and price at $4,000 to $6,000 packages. The difference is not subtle. Specific targeting produces specific actions. Vague targeting produces scattered effort. With vague targeting, you post on every platform hoping something works. With specific targeting, you invest deeply in the two platforms where your clients actually search. With vague targeting, your messaging tries to appeal to everyone and resonates with no one. With specific targeting, your messaging speaks directly to client priorities and concerns. Niche-specific businesses also see 20% higher customer retention rates than generalist operations. As you can see, specificity is not limiting. It is focusing your limiting resources where they produce results. Your target client profile needs demographics, psychographics, budget range, and decision factors. Each element informs different aspects of your marketing and service design. Required profile components include demographics like age, income, location, and life stage. Psychographics like values, priorities, and aesthetics preferences. Budget range covering what they expect to pay and what price signals quality in their perception. And decision factors addressing what matters most when choosing a photographer. Without these specifics, your marketing plan becomes guesswork instead of strategy. You cannot write compelling copy for a client you have not defined. You cannot choose advertising channels without knowing where your clients search. The client profile is not a formality. It is the foundation of every marketing decision. For photographers in large cities like Los Angeles, this specificity matters even more. The market is large enough to support narrow niches and competitive enough to punish generalist positioning. Define your client precisely, then build everything around that definition. Pricing based on what competitors charge instead of what your business requires is the third planning failure that kills photography businesses. Your competitors might be pricing wrong. They might have lower overhead, different income goals, or unsustainable business models. Copying their pricing without understanding your cost structure guarantees you will undercharge. 40% of creatives undercharge due to imposter syndrome and lack of financial clarity. The business plan process should force you to confront the actual math. If it does not, the plan has failed its primary purpose. Pricing based on competitors rather than your own costs results in 20 to 30% loss in potential margin. That margin loss compounds over time. A photographer who undercharges by $500 per wedding across 15 weddings loses $7,500 annually. Over 5 years, that is $37,500 in revenue that should have covered equipment upgrades, marketing investment, or personal income. Your business plan must calculate your costs of goods sold, add operating expenses, factor in time investment, and include profit margin. Then compare that number to market rates. Do not start with market rates and hope they cover costs. Here's the pricing calculation sequence. Calculate COGS for each service type. Add operating expense allocation per booking. Include time investment at your target hourly rate. Add profit margin as a line item. Compare total to market rates and adjust positioning or costs if the math does not work. If your cost-based price exceeds what your target market will pay, you have a positioning problem or a cost problem. Either way, you need to solve it before launching, not after. Keep COGS under 25% of your package price to maintain profitability. Factor in shooting time, editing time, and client communication time at your target hourly rate. Add overhead allocation for software, insurance, marketing, and equipment replacement. Include profit margin as a line item, not an afterthought. Then assess whether the price aligns with your market position. If you are targeting luxury clients, your pricing should signal premium quality. If you are targeting volume, your price should enable repeat business. Your business plan must justify your pricing with math first. The math determines viability. The positioning determines how you communicate that price to clients. Both matter, but viability comes first. Financial projections that show consistent monthly revenue ignore the reality of photography seasonality. They create planning failures that lead to cash crises during slow months. Your projections need to reflect how photography businesses actually operate, not how you wish they operated. New freelance photographers typically earn between $25,000 and $35,000 in their first full year of business. A realistic booking goal for a first-year wedding photographer is 5 to 10 weddings, not 20 to 25. Full-time wedding photographers shoot an average of 20 to 25 weddings per year, but that comes after years of building reputation and referral networks. Portrait photographers should target 20 to 40 sessions in year one, not 100. Your projection must account for the time required to build visibility, convert inquiries, and establish client trust. Overly optimistic booking numbers create revenue shortfalls that your cash reserves cannot absorb. These numbers may feel modest. They are also achievable. Building your projections on achievable targets creates a plan you can actually execute instead of one that demoralizes you by month 3. 80% of weddings take place between May and October. That creates a significant cash gap from November through April. Family portrait revenue peaks in Q4 due to holiday card demand. But January through March remain tight for most photographers. Your business plan must set aside 20 to 30% of peak season income for off-season expenses. Develop off-season services like headshots or product photography. Collect deposits during booking season to smooth cash flow. Seasonal planning strategies include reserving 20 to 30% of May through October income for November through April expenses. Developing complementary services that generate revenue in off-peak months, structuring payment terms to collect deposits during booking season, and avoiding major equipment purchases during cash-tight months. Financial projections that show consistent monthly revenue are not plans. They are fantasies. Build your projections around the actual seasonal patterns of your photography niche. Let me answer the most common questions. Should you skip the business plan if you are self-funding and not seeking a loan? You don't. You still need the thinking a business plan requires. Self-funded businesses fail at the same rate as loan-funded businesses when they skip financial projections, market analysis, and pricing strategy. How often should you update your business plan to reflect your actual results? Review financial projections quarterly to adjust for actual booking rates versus forecasted rates. Compare projected revenue to actual revenue. Assess whether pricing generates target margins and adjust next quarter projections based on trends. Monthly check-ins take 30 minutes. Quarterly reviews take 2 to 3 hours. Both are essential. If you want a business plan that evolves with real numbers and real positioning, start joining the Elite Success Accelerator for free. Link is in the description. Subscribe so you do not miss episode 5, where we are closing the series with how to write an executive summary that investors or lenders actually read. This is the one-page document that determines whether anyone reads the rest of your business plan. Thanks for watching, and I'll see you in the next one.